Welcome to our end of financial year edition of Taking Stock for the week ending the 3rd of July 2026. I'm Kien, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to your Think Share Markets. Well, Matt, what a year it's been, hey? Quite a challenging year, but the markets were relatively positive. How are you?
Yeah, it was a relatively challenging sort of year. Happy to be, turning the chapter to FY27. But I'm well, keen and really good to be joining you for the first edition for FY27.
Yeah, time has certainly flown, and it's great to have you back. But before we begin, just a reminder that today's discussion is general in nature and won't consider your personal situation or needs. Shares are volatile, so any past performance figures shown here aren't indicative of future performance. But Matt, well, it's been a volatile year, even though market returns were positive.
Yeah, it really was, Keen. But while the All Ordinaries Index did finish up the year about 6%, the headline number doesn't really tell that full story. We saw one of the biggest rotation in years, with performance varying dramatically between sectors as investors responded to the higher interest rate environment, that persistent pesky inflation, and the rapid rise of artificial intelligence.
Yeah, breaking into the sector levels, Matt, we saw resources. They were the clear standout with materials. They gained more than 50%, while energy consumer staples and utilities also delivered strong returns. And at the other end of the spectrum, it was healthcare. That fell more than 35%, courtesy of CSL and Cochlear. And also technology stocks lost roughly a third of their value as investors reassess their growth expectations.
Yeah, if you didn't have those mining stocks in the portfolio, it wasn't such a great year.
Mm.
But a lot of this does come back to interest rates. Inflation has remained stubbornly high, as we pointed out, and that's partly due to the high oil prices due to the Iran war. That kept bond yields elevated, which weighed on longer cash flow duration growth stocks.
Yeah, that's right. And artificial intelligence as well was another defining theme. Companies supplying the commodities that you need to build a AI infrastructure, they performed exceptionally well, while software businesses and healthcare stocks face increasing concerns around disruption and lofty valuations.
Now, looking at the performance by style factors, in general, stocks with strong earnings revisions and high dividend yields perform quite well, while traditionally quality, momentum, and value factors all lagged. It reinforces the idea that stock selection is becoming increasingly important, particularly as we approach the full year reporting season.
Yeah, looking at that chart, Matt, you can see that it was quite a challenging year for quality and growth investing. But our star growth stocks performed relatively well, returning just over 12% during financial year 26, outperforming the All Ords accumulation index by about 6%. And despite the poor performances from those healthcare stocks like Cochlear, CSL, our growth portfolios, they really benefited from the uplift in some of those stocks like SKS Technology and Codan and major resource stocks, which are benefiting from the capital spending cycle in AI and defense.
And meanwhile, the star income stocks perform quite well, outperforming the ASX index by over 2%. Exposures to resources, consumer staples, utilities, and not having the major healthcare stocks help drive that outperformance.
But it's not just about this year. Our star growth stocks have outperformed consistently throughout history, and this highlights the importance of having, firstly, a diversified portfolio of financially strong businesses, despite the challenges that we're facing, such as geopolitical risks and AI disruption across those growth stocks. And speaking about the challenges in technology stocks for under the microscope this week, let's turn to government software company, Objective Corporation. Now, the shares plunged by 34% after the company announced the Australian Department of Defence they had decided not to renew their long-term software support agreement. Matt, can you firstly explain what Objective actually does?
Yeah, so Objective develops software that helps governments and highly regulated organizations securely manage documents, records, and workflows. Think of it as the digital filing cabinet and document management system behind many government departments. Once embedded, these systems to be sticky because switching to another platform can be quite expensive and really disruptive to the underlying operation.
Yeah, this probably explains why the margins and return on equity are so high. But if contracts are sticky, Matt, why did the Defense Department decide to leave here?
Golden question, isn't it? And that's exactly what we're trying to understand.
Mm.
Now, Defence will continue using objective software, but has chosen not to renew the long-term support agreement. While that's no impact to the FY26 numbers, it significantly reduces recurring revenue entering FY27, with annual recurring revenue now expected to broadly be flat instead of growing 10 to 14%.
Yeah, and based on our estimates, it suggests a loss of around 12% of their total revenue year on year. So that's quite significant. But the shares are now trading at a substantial discount to where they were a week ago. Does that make the stock attractive here?
It's certainly much more attractive now, but we'd be cautious about calling it cheap just yet.
Mm.
Even after the sell-off and the partial recovery, the stock still trades on around 17 times forward earnings, which isn't demanding for a quality software company, but it's not a bargain either if growth has structurally slowed.
And that's why we've certainly placed it under review. The key question now is whether this is an isolated event or whether it fundamentally changes the original thesis or has completely eroded its competitive advantages.
Exactly right, Keen. So we'll be trying to investigate the reason for the non-renewal of this particular contract. How realistic is it to replace a contract of the size, given that the long government procurement cycle, and whether AI strengthens Objective's competitive position or gradually erodes the high switching costs that have historically underpinned the business.
Our question of the week ties in nicely with the end of financial year, but remember, ultimately, it's earnings that drive share price over the long term. And Matt, the question this week is, what are the earnings growth expectations for the market over the next 12 months?
Okay, and overall looks cautiously optimistic. One of the more encouraging developments is that earnings revisions have started to stabilise after a pretty sharp deterioration early this year following the February reporting period. You can see this with the chart on screen comparing the earnings trends in orange versus the market in blue. However, that improvement has been driven largely by resources, while earnings revisions for banks and many industrial companies remain relatively subdued.
Yeah, very interesting, but not surprising that Matt. Analysts are forecasting, though, that earnings growth for financial year 27 for the Australian market is expected to come around 10%, although resources again are expected to lead the way, even though growth should also broaden across all the other sectors if inflation continues to ease and economic conditions remain resilient.
That probably reinforces why we continue to favour selected resource companies such as BHP, Rio, South32, and Sandfire, which are all tied to the electrification thematic. We also like mining and infrastructure service providers like SKS Technology and defence stocks like Codan.
Yeah, but outside of that group, I think there are opportunities because there's a few stocks that have been sold down, like for instance, Hub24 and Netwealth, where earnings have actually remained resilient, but those stocks have sold down on the back of AI disruption fears, allowing incumbent providers like AMP, for instance, to defend their market share. And these stocks are driven by market sentiment, which remains relatively positive and move with cycles.
Yeah, and at the same time, I'd be a little bit more cautious on areas where earnings expectations are already quite full, particularly parts of the banking sector. Banks have benefited from the defensive characteristics and attractive dividends, but earnings growth looks relatively modest, especially if the housing market continues to weaken. And for industrials, I think investors need to be increasingly selective because we're seeing a much wider divergence between companies upgrading and downgrading their earnings.
Yeah, certainly the case this confession season. And yes, if earnings revisions continue improving, particularly outside of that resources space, the market will likely drift higher, especially those industrial companies. But be prepared for greater dispersion in returns, meaning owning those financially strong businesses with improving earnings will matter more than simply just earning the market index. But that brings us to the end of this week's episode of Taking Stock, Matt. Thanks again for your time.
My pleasure, Ken. Thanks for having me.
And before we wrap up, just like to thank you to all our members for your continued support throughout another financial year. Despite that challenging market environment, our portfolios managed to finish the year ahead of their benchmarks, and we hope many of you did too. But we look forward to continuing to help you separate the noise from what really matters. Until next time, have a happy, healthy, and prosperous week ahead.